On June 17th, the Canadian dollar put in a low against the US dollar not seen since 2020. Since that time, it's rallied almost 2%, outpacing its G10 peers. Several factors have supported the Canadian dollar, including persistently high oil prices, which historically correlate positively with the loonie, but also because of hawkishness from the Bank of Canada, which now appears to be on par with the Fed. By contrast, the ECB rhetoric has shown some reluctance to hike aggressively to fight inflation due to the economic worries over the Ukrainian conflict. Futures markets expectations for the Bank of Canada are priced in to hike 75 basis points at its next meeting on July 13th, which would be the biggest increase in 24 years. Coincidentally, that same date, July 13th, also happens to be the day of the much anticipated US CPI number. The last CPI number surprised to the upside and sent currency markets into a wild repricing of central bank policy. Now, the CME Group offers 3 different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micro in these examples. If a trader believes the Canadian dollar will continue to rally against the dollar, they could express that by buying the September micro Canadian dollar futures contract at spot 7780 and targeting April highs of spot 8050. A stop for this trade could be placed at new lows of 0.7600. This trade could make $270 if your target is reached and risks $180 if you're stopped out at your level. Now, if a trader believes the Canadian dollar could head lower from here, they could express that by selling the CME September micro Canadian dollar futures contract at the same spot 7780 and target 2019 lows of spot 7350. A stop for this trade could be placed above at spot 8100. This trade could make $430 if your target is reached and risks $320 if you're stopped out at your level.